So this morning at our team meeting, we actually had a special speaker, Elsie Wu, and her husband, Eric Sit from Abundance 99. And they talked with us about a special bridge loan program that they have for homeowners who are thinking to sell their home and to buy a new one. So this helps to bridge the gap in many ways, and it's a really neat program. And I thought that it would be good to share with the rest of our people that we know, our clients and community. So I'll be sharing you this video, and we will include links for Abundance 99 for their company in the description, so that you can contact them if this is something that may be something that could work for you.
So let me do a very quick introduction of our company and of Eric and me, and then we'll jump into the slides. So we actually, Eric is actually my husband. We started doing real estate investments about 16 years ago. And then we started buying apartment buildings, commercial properties, and we did hard money loans. And we thought we were going to live a passive income lifestyle from our tech jobs. And then the real estate market crashed. We lost about $9 or $10 million of our own money and our investors' money. So at that time, we had a choice of either going full-time into real estate or going back to high tech. So I figured after we paid $9-10 million of tuition, we better use that to protect our investors and help our investors recover some of what they have lost. So we actually formed the brokerage back in 2009. I am a licensed broker, but most of what I do is actually hard money loans and these conventional loans that you'll be hearing about a little bit later. But most of our business is actually from these loans where we have local Bay Area investors, people who are generally just really good savers, tech people, biotech people, really good savers who save their money, and then they're investing with us into these bridge loan deals. And all of our deals are in California. All of our deals are, we personally visit all of the properties, if not inside, at least outside. So then we can protect our investors because of our local knowledge and local due diligence. So this particular bridge loan was actually our most popular loan product last year. And that was to our surprise, because we didn't think that people would be doing bridge loans. So we were surprised at how popular bridge loans were last year. And we were also surprised at the different people who were using the bridge loans. So I'll talk about that a little bit also. But we're finding that real estate agents are loving this bridge loan tool because it really helps them close deals faster and smoother than they had anticipated. So I wanted to share this loan product with you. We do have other loan products also, but I want to share this with you first because you'll hopefully boost your business by removing some seller objections. So our first slide. So what is owner-occupied bridge loan? So the term bridge loan is used quite often in different contexts. Very often it's used for commercial loans, for multifamily, where people are getting the loan for a short term. But generally, it's not applied to owner-occupied loans. And the reason that this is important is because at the federal level, there are a lot of regulations when it comes to owner-occupied. So there is the requirement that you have to have them demonstrate and you have to verify their ability to repay. That means you have to collect income statement, you have to collect tax returns, you have to do all the debt to income calculations when it comes to owner-occupied properties. Well, there is one special exemption. It's for people who are moving from their primary residence, from existing primary residence to a new primary residence. So the purpose of the loan is specifically to help them move without having to sell the property first. And then so on this slide, you'll see all the different federal regulations that apply and that don't apply. So very often the first question we get is, well, okay, so why don't banks offer bridge loans? And the reason that banks don't offer bridge loans is that some of our loans only last 5 or 6 weeks. Banks, they're looking for long-term residual income, right? If you get a loan for 5 or 6 weeks, that's a lot of upfront paperwork to them. And then they don't have that ongoing income stream. So in fact, if you work with a conventional mortgage broker and you pay off your loan for, in less than 6 months, they will claw back all the commission that they have paid to the mortgage broker. And if it's with a bank, they will claw back the fees that they pay to, or the bonus that they pay for the bank's loan officer. So banks don't want to do it. Banks discourage mortgage brokers from doing anything like this. And we filled this niche in the Bay Area, and it's for people who are moving within the state or moving to other states. So I'm not going to read all the details of the bridge loan regulations, but the key thing to remember is that it's equity-based, not income-based. It's from primary residence to primary residence. It's intended for loan of less than 12 months. So ideally, you want to help the client find a new home first. They move into the new home, they sell the existing home, they either pay off the bridge loan or pay off the existing loan or pay down the existing loan and then refinance to a new loan. You want to complete all of that within 12 months. So far, we have only had one client that needed the whole 12 months. Everyone else is 5-6 weeks, sometimes 3 or 4 months. It really depends on how quickly they refinance or how quickly they sell their home. So we'll talk about some of that later. So because it's not dependent on income, we're okay if they have limited income or no income as long as they have equity. And if they have financial struggles, for example, they have mortgage deferral, we're okay with that. But if they've had bankruptcies, then we will want to review that before you submit an offer with no financing contingency. So we'll talk about that a little bit too. Jean, would you go to the next slide, please? Okay, so initially when we started offering bridge loan, we thought it was for people who were cash strapped. And to our surprise, it's not just the people who are cash strapped, but also people who are thinking strategically about their taxes and about boosting the value of their home. So we'll have a few loan scenarios addressing that. But these are the most frequently heard seller objections. And when you hear these objections, I want to invite you to think about bridge loan as a possible solution. So for example, very often we hear from sellers, hey, I can sell first, but what if I move to a rental, prices go up and I can't find anything else I want to buy? So I think that's one of the most common objections we have heard. And also more common now because sellers don't want to move into a rental during COVID-19, and they don't want to have visitors in their house during COVID-19. So they want that new home first, but they don't necessarily know how to make it happen without, qualifying for a second loan or having enough down payment for a new house. So these are the things that, when you hear these cues from the sellers when you're trying to get the listing, think about how we can help them. So for example, some of them, they want to paint, they want to recarpet, but they're living there, they have pets. They can't possibly paint and recarpet, but they also want to have they want to sell for top dollar. So it's a catch-22. But if we help them move first, then they can leave the place vacant. So you can find better, less expensive solutions to painting, to carpeting, for example. And then you can help them sell for more and faster at the better time of the year, for example. People say that they don't want to move twice. People worried about pets, especially the families with big dogs. A lot of the apartment rentals don't allow dogs more than 25 pounds, and they don't allow more than one dog. So if they have 2 or 3 dogs, or if they have big dogs, they don't have a place to go to unless they have family that can stay with. So we have found that for the people with pets, they also love this bridge loan solution because it removes their dependency on their relatives or their friends for that extra space. And then, of course, we hear very often that retirees, they don't have the down payment or they don't have the income to qualify for another loan. So the solution then is to use a bridge loan to buy first and then sell. we're hearing about HomeLight entering the Bay Area market, offering something similar. They'll buy your home so you can buy something else, and then they'll help you sell. And then, by the way, they want commission and they want some kind of a carrying cost alongside that. So we're avoiding that because we want a strict lending relationship. The borrower has total control on how they renovate, how they sell, when they sell, but hopefully within 12 months. So with a bridge loan solution from Abundance, you can overcome these seller objections and be in a better position to compete with other agents in the market. Okay, so next slide. So I have three recent successes to share with you here. This one here is what we thought would be the typical bridge loan borrower initially. So, people have owned their homes. This couple, for example, retired. They have owned their homes for about 40 years. It was updated maybe 20 years ago, 25 years ago, 30 years ago. Now they're retired. They're living on Social Security, and they're about to run out of liquid reserves. Okay, so most of their assets are in that house. So they need to tap into that house for living expenses pretty soon. And they wanted also to move closer to their kids. So they found a house for $850,000, single story in Novato. And we actually gave them 100% of their purchase price. So if you look at the numbers here, their existing home is worth 1.3. They have $375,000 of outstanding mortgage. They're buying a new home of $850,000. We lend them $850,000, which is just enough for their new home purchase. And that loan was secured as a first mortgage on the new home and then a second mortgage on the existing home. The combined loan to value was 58%. And then they sold their existing home. So they moved out. The real estate agent was able to paint and recarpet. They actually changed to hardwood or laminate flooring. And then it sold about 2 months later. Well, it sold in about 4 weeks, and it took another 4 weeks to close escrow. So after they sold and closed escrow, they paid down their loan by $500,000, leaving $350,000 as the balance on the bridge loan, which is only secured by the new home at that time. Because remember, they sold their old home, right? So they sold their old home. When they sold the home through escrow, they paid down our mortgage. And then we worked very closely with the mortgage broker on that transaction so that 2 weeks before they were closing escrow on that sale, we started getting them the documents they needed to refinance. And then they refinanced at, I think at around 2.6% interest rate. That refinancing paid off our bridge loan. So that refinancing was a new first mortgage at the low 2.5, 2.6% interest rate. And that gave them around $450,000 for stocks and mutual funds for their ongoing living expenses. And the total bridge loan duration was 3.5, well, about 4 months, 3.5 to 4 months. So this, we thought, was going to be the most typical scenario. And we do have, I would say, maybe 30% of the borrowers fitting this criteria. Most of their assets are in that home. They need to start liquidating, and they also want to move closer to the family. And in this case here, they moved from San Francisco to Novato, which is only an hour away. But we've had other clients moving to Texas, actually a couple other clients moving to Texas, some people moving to Sacramento or near Sacramento area. So this is a pretty common scenario. Now, Jean, if you would go to the next slide.
Can I ask really quick, how this bridge loan that you had, this is a great story, by the way.
Thank you.
How much percent-wise, what's the rate for the bridge loan in this case?
Yeah, because this is such low LTV, the interest rate was 7.95.
Oh, okay. That's
Yeah,
not bad. And then that's only for 3.5 months that we're talking
right,
about.
exactly. And there's no prepayment penalty. So they could pay off anytime they want it. And that's why we work very actively with the mortgage broker to make sure that they're able to refinance very quickly. And we have great reviews from these customers and the mortgage brokers. Yeah, they're loving the solution.
Yeah, it's great. Any other questions before we go on, or if not, I'll go ahead and go to the next one.
Okay, so this is a interesting one that was to our surprise, and it started happening in March of last year, and we think this is going to happen even more often. So I would say right now about 50% of our loan volume for bridge loan is actually from this scenario, similar to this scenario. So these are people who are financially really strong. I mean, we've had clients that have had 5, 6, 8, $20 million sitting idle in their brokerage account. So we were really puzzled on why they would use a bridge loan. Okay, as it turns out, their private bankers and their financial advisors are telling them, hey, the stock market is great. Don't sell stock market to buy your new home if you're only facing a short-term financing need, right? Once you sell your existing home, if you're not planning to keep it as a rental, really you just need funding for a few months. So rather than paying the, I don't know, is it 19% of capital gains tax to IRS, 12% to the to California, and then the 3.1% federal Medicare tax, rather than paying around 33% of capital gains taxes, to have use of your money for 2, 3, 4 months, just get a bridge loan. And then after you sell your existing property, pay down the bridge loan, but don't pay it off, refinance to a lower rate mortgage so that you can, you don't have to do a cash out, because cash out is more difficult to qualify sometimes. So they don't want, so the financial advisors and the private bankers are advising their clients to pay down the loan, refinance, and then have more money to put into the stock market and mutual funds without touching their stocks and mutual funds. So we were surprised at how popular this loan product was. And these were people, for example, in this one case, their loan to value was only 37%. And that's very common. So last year we've had people who were retired CEOs who were moving from a $5 million house to a $3 million house using our bridge loan. And these people, they think of this as a luxury option. They can move safely. They don't have to pay additional capital gains taxes just for the short-term use of their money. And their private bankers are actually encouraging them to use this solution because many of the jumbo loan products have disappeared since COVID-19 started. So prior to COVID-19, there were a lot of different jumbo lenders, and private bankers were offering their solutions to these clients to buy the bigger homes, the $3 million, the $4 million homes. After COVID-19, the private bankers were, their hands were tied. They could not close some of those loans. So what they instead decided to do is have us do the bridge loans so their clients can close escrow smoothly and without any glitches. And then they help them refinance after the existing home is sold. Then that becomes an easier loan without the timeline sensitivity of a conventional jumbo loan. So this was very popular last year, and we expect more of it this year as well. Any questions on this one before we go to the next page?
Did you want to go through the detail, or is it pretty much similar to?
Yeah, it's pretty explanatory, self-explanatory. Okay. This particular couple, they moved from Menlo Park to Santa Barbara. Again, it was because they didn't want to deal with the stairs anymore, and they needed to cash out. They were also running, they needed to cash out because they didn't want to touch their stocks and mutual funds. They didn't need to cash out because they were running out of money. So it's a very different problem than what we were anticipating.
So I have a question. So when somebody is putting in an offer, as this would just show as a non-contingent funds that are already available to them.
Right. So we will actually do a pre-approval. So we'll talk about that in a little bit.
Okay. Yes.
So we encourage the borrowers to talk with us first. We can run the numbers for them to see if it makes sense. And then if it does, we'll provide a pre-approval with our proof of funds.
Okay.
So when you submit the offer, you'll have the pre-approval and the proof of funds. And you don't, once we have approved them, you do not need to have a financing or appraisal contingency.
Cool.
Okay, so it could be a very clean offer.
Right.
It does potentially mean two separate escrows.
Sure.
Okay, one for the existing home, one for the new home. So we'll need to make sure that the escrow officer is experienced enough to handle two escrows where the money feeds from one escrow to the next escrow. But we can guide them through that if they're not already familiar with it.
Yeah, I mean, that should be very easy. So, okay, I
Okay.
went ahead with the next.
Yes. So this is the third example. Again, it was to our surprise. So this is a home in Menlo Park, or a family in Menlo Park. No, sorry, Mountain View. Family of 5 sharing one bathroom with only one sink. They were driving each other nuts last year. And so by the time they came to us last December, they were already at each other's throat. The wife wanted to buy a bigger house. They had money. They had equity. The wife wanted to buy a bigger house. The husband wanted to make more money. So the husband doesn't just want to buy any renovated house. The husband wants to buy a bargain. So they found a house in their neighborhood where the previous owner got sick in the middle of the renovation. So they never finished the renovation. But because of the condition of this house, they could not get conventional financing. So what we did was we did a bridge loan, again secured as a first mortgage on their new home, second mortgage on their existing home. We lend them the entire amount of their purchase price. So in this case here, $1.91 million. The combined loan to value was 78%. And we'll show you that calculation in the next couple of slides. So then we did the loan for them. And then they started, as soon as they closed escrow, they used their own cash to start renovating that house. And then they themselves moved into a short-term rental, an Airbnb, for about 2 months while they staged and marketed and sold their existing home. Once they sold their existing home, they paid down our mortgage by $560,000. And now and then they started refinancing to the on the new home at $1.35 million, and they're working with a credit union on that. So that we're expecting the loan payoff this week. So this made a difference for them because in this particular case, the seller of the home they bought had a choice of selling to a flipper who wanted a bargain, or to a family who could really use the space. And this particular seller wanted to help the family. Now, they didn't pay a penny less than any of the flippers, but they were chosen because the seller wanted to work and help a family in need. So they did that. And then the seller liked the fact that the offer was basically all cash, non-contingent, right? Because no financing, no appraisal contingency. So seller considered that to be really important. So they got the property that they wanted. The husband had the opportunity to improve on a property without paying for the renovation that they may not have liked. And then the wife is really happy that they have a bigger home. And in this case here, their annual income is around $550,000 to $600,000. So they could easily have qualified for a loan if it weren't for the fact that this is a fixer. So our bridge loan helped them buy the fixer and move into that fixer 2 months later. Any questions on this one? Okay, so the next slide, how much can I borrow? So I'm sharing this with you just so you have the context. And then later on, when you have a client who's interested in this solution, we'll definitely talk on the phone to make sure that we run the numbers together. but this is a very high level overview so that you can determine how much the client may qualify to borrow. So in this case here, let's say the existing home is $1.2 million. The new home is $800,000. So the combined total value of the two properties is $2 million. Okay, so then if you use 75% combined loan to value, then the total loan amount could go up to 1.5. From that 1.5, we subtract the existing mortgage outstanding balance, $350,000. So they can potentially borrow $1,150,000 towards their purchase. In this case here, they don't actually need that. They only need $800,000. So then we'll lower the loan to value. And when we lower the loan to value calculations, they also get a lower interest rate. So our interest rate is always tiered based on risk. So if it's an excellent borrower with credit scores in the 700s or 800s, it's below 60% loan to value, then our interest rate is at 7.95. If the interest rate is if the loan to value is 75%, then the interest rate is I think 8.95. So it goes up by 1%. And then it goes up higher if they need 80% loan to value. So we can do that, but we try to make sure that the client is budgeting wisely and not getting themselves too far and too deep.
And Elsie, in terms of the existing home value, how do you come up with that amount? Is it just a market value, or do you do an appraisal, or?
Yeah. So we don't do an appraisal because appraisal is very reactive.
Mm-hmm.
What I have access to MLS,
Mm-hmm.
so I actually will do my own broker price analysis,
Mm-hmm.
and I will check Zillow, I will check Redfin, I will check Real AVM. I'll talk to the borrower just to understand all the different aspects of the property, mm-hmm. and then I come up with my own valuation. Very often, the client will think their house is worth a lot more than it really is, especially if they're not able to spend the additional money to renovate.
Sure.
So for the existing home, we use I will do a broker price opinion. For the new home, if they're in contract, it's an arm's length transaction, mm-hmm. then we'll just use their purchase price.
Sure.
Yeah. And every now and then, for example, if that market is really booming and they feel that it's important for me to call the local real estate agents, I will ask the local real estate agent who may have referred the deal to us for their own market comparables to help me understand what's going on in that neighborhood, so we're giving it fair value.
And I see this is on your slide, actually, so I was just
yeah
the question, you just answered my question in there.
Right, it comes up a lot. Yeah. So then also the question is, do we need appraisal, especially if it's over $1.5 million? Mm-hmm. For jumbo loans, if it's over $1.5 million, very often the lender will require 2 appraisals. Mm-hmm. For abundance, we don't require any appraisals at all. That also saves you time, stress. There's nothing that's set in concrete. We're private lenders. As long as we follow the federal regulations, there's a lot of flexibility to what we do. We just want to be fair to all the borrowers in all the different scenarios. Okay, so next, please. So very high level, I want to give you a sense of timeline and then how your client will go through this bridge loan experience. So let's say you have a seller who is shopping for agents, who wants to see what you can do for them. Well, so if bridge loan is the right solution for them, or maybe a possible solution for them, then the first step is for them to give us some basic information so we can calculate how much loan they can get. Okay, just like that example that I just showed you. Once we determine that they're comfortable with that amount and there's nothing unusual in their circumstances that would prevent us from giving them a loan. So for example, if they have prior bankruptcy, or if one of the properties has severe foundation issues, or let's say there is living trust, irrevocable trust issues, then we'll work through those first. But let's say everything is normal, then we'll invite them to submit an application. They'll provide us with tax returns, bank statements, just so that we know more about them, and then their current mortgage statement. Then we'll issue a pre-approval letter with our proof of funds for the dollar amount that they want to see. They want to show on their pre-approval. And then you can help them submit an offer with no financing or appraisal contingencies. Then once the offer is accepted, we will try to use the same escrow officer to open escrow on both the new home purchase and then the existing home cash out refi. Okay, sometimes using the same escrow officer may not be possible. For example, if one is in Southern California and they don't want to touch a Bay Area property, that may not be possible. But let's say it's the same escrow officer. Then we will work with that escrow officer to provide loan disclosures, to do all the document signing. And once the loan docs have been signed, we need to give the borrower a 3-day right of rescission. And then after that, we would fund the loan, the entire loan amount to that refinancing escrow, or the cash out refinance escrow on the existing home. So if they want more money for the moving expenses or for renovation, it would be all funded through that cash out refi escrow. And then that escrow officer will transfer the money, necessary amount, to close escrow on the new purchase. And then anything that's left will be sent to the borrower for their moving or renovation expenses. And then after their client closes escrow on the new purchase, then they can update the new home, move into the new home, update, stage, and market the existing home. When their home is sold, well, a few days before the home is sold, we ask them to contact us and let us know if they want to do a pay down or a payoff. So let's say if they want to do a pay down, then we'll just give them give escrow instructions to collect just enough for the pay down and leave and remove our lien, our mortgage on the existing home. So you can close escrow with clean title. And whatever is left on the bridge loan will be secured only by the new home. And then the mortgage broker or office will help them refinance to a new rate conventional mortgage. And that refinancing will be used to pay off our mortgage. So the total duration, as shown here, is probably anywhere from 5-6 weeks to, let's say, 3 to 4 months, depending on how much renovation they want to do. Any questions about this?
Well, timing in terms of, so if an offer is accepted, how much time does it take to be able to close escrow? So if you're writing an offer, what's the time frame?
Right, we need 21 days in the contract. And the reason is we have to go through the same loan disclosures as if it's a conventional cash out refi. So that means the initial loan estimates, wait 4 days, and then the closing disclosure, wait 3 days, and then signing the loan docs, and then wait 3 days. So there's a lot of waiting time in between. So 21 days is what we need.
Any other questions from people? Have you had any situations where I just one more any situations where somebody has a hard time? I can't imagine why, but they have difficulty refinancing the portion that they're going to continue on the bridge loan?
No, we haven't.
No? Okay.
We haven't. Yeah. I mean, generally, when they work through us, if their intention is to refinance, we try to qualify them.
Okay.
To make sure that they are able to refinance, because we don't want to set them up in a situation where they obviously don't qualify to refinance and they become stuck in our expensive mortgage.
Right,
yeah.
Right. So that's part of why, even though there's the equity there available, you also make sure that they're creditworthy, that they qualify when they need to.
Right.
So like their bank statements and credit reporting.
And we're also very honest with them. For example, we did have this one client from San Francisco. This is from maybe 14 months ago. She had health issues, credit issues, and she was working with a real estate agent. She fired the real estate agent, hired someone else from Redfin, I think, and then went back and forth. And she was not listening to recommendations from the market experts.
Mm.
So we really, we look at her credit situation. We say, hey, by the way, in order for you to come out ahead on this one, you need to buy a much smaller house.
Mm.
Just because you're selling your home for $1 million does not mean that you should go buy $1 million house.
Right.
You really need to think outside the box, move up. Initially, she wanted to be in Berkeley. Then she wanted to be in Oakland. Then she wanted a single family home. And, it's not cheap. So finally, I think she settled in near Sacramento. But it took a while for her. And she, we basically spent a lot of time just educating her to make sure that she was not setting herself up for failure.
Okay. Well, that's really good to hear, because I think, I started real estate 2008, and I was hearing a lot of stories of people who got into loans in situations they shouldn't have been, and people too eager to lend to people when it's not maybe the right fit for them. So it's good to hear that, you watch out for people and try to be honest with them.
Right.
So
Eric and I, we're trying to build a lasting business, an enduring business. We want to be here our family lived to 100. So we want to be here, and be available and accessible to our clients for the next 30, 40 years. So our reputation is very important for us.
Mm-hmm.
So we want to do the right thing by the clients.
That's awesome.
So next slide, please. So some of the nitty-gritty details. So our interest rate starts at 7.95 for the clean files with low LTV, good credit score. And on the left-hand side, you see the typical loan terms for this type of clean file. When I say our loan fee goes from 1% to 1.35%, it's really because it takes about the same amount of work for us to do a $1.4 million loan than a $3 million loan. So we don't charge higher. We actually provide a discount for the larger loan amounts. So for anything under $1 million, for anything under $800,000, our loan fee is 1.35. Then once it goes over, I think 1.2 or 1.3, it drops down to 1.15. And when it goes to 1.6, the loan fee drops also. So our interest rate goes up based on the risk, the loan to value, and our loan fee goes down based on the dollar amount. And the key thing to keep in mind is that we want real estate agents to be actively engaged with the borrower. If you refer a client to us and the client is iffy about listing, about selling, to us that's a bad sign that they're not necessary. Maybe they're looking for a cash out on their home. They're really not intending to sell their home, which means that bridge loan is not the right solution for them. So we always make sure that the borrower knows we want them to work with a referring agent and make sure that they have a good game plan about renovating the property, selling the property, closing escrow, and refinance. We want to make sure they know the whole process from the very beginning. The other thing that I want to mention is the loan fee must be paid out of pocket. So this is a federal regulation. The federal government doesn't want us to lend money for people to take equity out of their home on a quote unquote high cost loan like this. So the borrower needs to somehow bring to escrow the loan fee, the 1% or the 1.35% loan fee to escrow. It's okay if they borrow that money from their family or their friends, or they borrow that money from their IRA, but we cannot lend them that money. Well, I mean, eventually I'll go back to them after we close escrow, but we cannot lend that money for the loan fee. Okay. So the left-hand side are the common scenario for a clean file. The right-hand side are some of the more unusual situations. So for example, we can go up to 80% combined loan to value, not a problem. We just need to underwrite it in a slightly different way. We may be more conservative with evaluation, for example. And then we may spend more time on the loan disclosure to make sure that the borrower is not overstretching on their finances. For our clients that are moving out of state, we're not going to secure the loan by 2 properties. So for example, if they're selling $1 million home and buying $1 million home, so they're selling $1 million home in California, buying $1 million home in Texas, then we're only using the California property to calculate the loan to value. So then in that case, if we're lending them $800,000, that loan to value will be 80% instead of the 40% if we were to use 2 properties. Does that make sense? So it's because it's going to be hard for us to do due diligence or to enforce the loan when it's out of state. Okay, the third bullet, it's okay if the borrower wants to beat the system, getting lower interest rate by getting us additional properties to secure for the loan. So remember, some of our borrowers are financially very, very strong. They have, $3-4 million in a brokerage account. They have rental properties, and they want to get the lowest possible interest rate. So then they would sometimes give us as a security collateral their existing home, their new home, a rental property. So for us, it's all the same. It's the same process, the same paper. Well, it's a little bit extra paperwork, but we're perfectly happy with that because that lowers the risk for our investors and it helps our borrowers get a lower interest rate. So that's also very doable. And I've mentioned that the loan can be used for moving and renovation expenses, and we can be a second or a third mortgage on the existing home. So for example, if they have a primary residence with a first mortgage of $300,000 and a home equity line of $80,000, and the home equity line is already all tapped out. Okay, so then we would be the third mortgage behind the first and the second mortgage. And that's fine with us also. The key thing to remember, though, is that if they have an open home equity line of credit that they haven't touched, we'll want them to close it because we don't want them to have a first mortgage and then after our loan is done, they pull out a lot of money from the home equity line of credit. That will reduce our loan security. But otherwise, we're happy to be a second or a third mortgage. And yes, for people who have credit issues, if they have a third-party loan guarantor with excellent credit, we can do that also. Okay, so getting started, as you're talking with your potential sellers, here are the 3 steps to remember. The first one is let's figure out how much they can qualify for before they start shopping. So if they're buying out of California in Texas and they want to use 80% loan to value secured by both properties, that may not be possible. So gather some basic information such as the outstanding loan balance on their first mortgage on their existing home, their target price for their new home, and then we'll figure out how much they can qualify. So that's the first step. And the second step is once they're ready, encourage them to apply online because it's more secure that way. We need tax returns, we need mortgage statements, if there are any outstanding mortgages, and we need bank statements. Easy, okay? And then once we have all of that, we'll get the pre-approval to you within 24 hours. And then with the pre-approval and our proof of funds, you can submit offers with no appraisal or financing contingency. Just keep in mind, please, that we need 21 days to close escrow. That's it.
Thank you so much for joining us. I think this is a great product. It's good to be able to have something to, again, open up options for our clients. And I'm excited for that. I'm so glad to meet you both and, really hope that your business goes well and hope that we'll be able to work together in the future.
Thank you. Thank you very much for having us.
So that's it. That was a really interesting conversation. And if you do, again, if you're interested and this might be something that will help you, we will have their contact information in the description below. I really love the fact that their name is Abundance. And as people who know us know, Perisson is also Greek for abundance. And so I love the fact of being able to have options that we can provide for our clients and our community. And I hope you find that useful.